So hi everyone. So today I'm just going to talk about the very basics of technical analysis in stock trading, right? So there have been, many people will talk about candlesticks, chart patterns, things like that. But if you are trading stocks, whether it's positional trading, whether it's intraday trading, or whether it's swing trading, right? The first concept you want to understand is about momentum and stage analysis. Stage analysis is a great concept coined by Stan Mainstein. So I have recommended his book in the last episode. Um, I will just briefly go through what stage analysis is and how you can spot that in a chart. Whether you are an investor, whether you are a trader, it will help you to identify chart patterns. And what it helps you is to be in the stock that are in the moment, right? Your money is not tied up in a particular stock which is going sideways for months to years. When you understand stage analysis, you will get to enter a stock which is in the momentum, then hold on to it for the crux of the momentum. It is not designed to capture the very bottom of the stock, and it's not designed for you to get out of the stock at the very top of the stock, right? Um, so let's just say you believe in one any particular stock. I'm not picking the names, so these are past examples. I'm not here to talk about any particular stocks or anything like that. But in general, just look at this particular chart, right? So this is a weekly time frame chart. So if you are an investor, right? So if you believe for whatever reason, this is December 03. So if you believe, you have studied the chart and you believe that this company has a great potential, right? As a value investor, as an investor, or not as a value investor, as an investor or as a trader, whatever it is, right? You are looking for a point where you have a low risk of entry. If the stock starts coming from where the point you entered, you are basically able to put a 5 to 10% stop loss and exit out of that trade. That's the objective of having a entry point, right? So in stage analysis, if you look at this particular chart, so look at this particular phase of the stock, right? So the stock starts picking up momentum from here. If you this candle basically, right, huge volume, the stock starts picking up momentum. Then it goes sideways from 03 to up until somewhere around July 04. So from December to July. So 1.5 years, the stock basically just go on a sideways moment, right? So if you enter the stock somewhere here due to whatever reason, your money is tied until this point for about 1.5 years. And value investors use this as an opportunity to accumulate the shares. So they don't really look at the chart, but the chart will speak about the actions of value investors. So that's the beauty of chart analysis. So if you combine fundamental analysis with chart analysis, you probably have an edge. I mean, you don't necessarily need to do that, but if you do that, you will have an edge, right? So if you believe in this chart and you believe that valuations are good, stocks prospects are good, then you will start accumulating somewhere here when the valuation is when the stock has gone up, but then it's corrected. You start accumulating. Then you can hold for some time, then for it to break out. If you understand stage analysis, what you can do is you can probably enter it somewhere here when the stocks start moving out of the range, right? As a trader, you can put your stop loss somewhere below and ride the entire wave for a great risk reward ratio. So let me explain the topic of stage analysis. In stage analysis, there are four stages, right? Stage one, stage two, stage three, and stage four. So this is basically stage one. Stage one is basically the stock is moving sideways or it's rather getting accumulated. So big players, institutional players, big value investors, big investors are accumulating the stocks slowly over this period of time. They cannot buy stock at one go, right? If you have $1 billion and if you're buying stock like this, right, you cannot buy it at one shot. You have to divide your money into chunks and you have to buy it load by load by load. Over a few weeks, months, you will basically accumulate. So many big players will accumulate that. At one point of time, the supply get dries up and the demand gets, overtake demand overtake the supply, and the stocks start moving up. This is basically called a breakout. So you're breaking out into a stage two. You can look at all the moving averages. The moving average is all right behind your price, and it started trending beautifully upwards. So you're now moving into a stage two. You can basically ride your stock. So here it's again forming a congestion. You can add some quantity here if you want to, but in general, yes. If you look at this, then from after the point of the breakout, the stock just keep moving up, moving up, moving up until it reach a point like this, right? So from a price point of about 11 rupees, it has reached a point of 80 rupees, and basically now the stock has become an eight bagger, right? uh, all you had to do is buy the stock, simply trail that stock with any of your particular moving average. You can use a 40-day moving average, you can use 30-week moving average, 50-week, up to you, right? Basically up to you. You find your own. I mean, the longer moving average you use, the longer profit you might be able to give, and chances of whipsaws are also there. But yeah, in general, you can trail the stock, and it this is where the stock peaks out, right? Momentarily, or I mean, for a considered long period from here. And this is where stage two ends. So it started moving sideways. So once it started forming big red candles to the downside, so it's basically here it's then breaking this range which is just been it just formed from Jan 0 to June. For 6 months it has been ranging, starts breaking out. So that's where it starts forming a stage three, right? So I would say this entire phase is a stage three, is basically consolidating. The stock is not really moving much, it's just ranging up and down here. And look at the period which it has been ranging, right? And finally starts breaking down. So from, if you calculate this as the range bottom, it starts coming down from here, right? So this is where the stock starts moving to stage four. From stage three, it started moving to stage. It's not a great example, but yeah, this is how it is, right? It started breaking down, and this is kind of a short period of stage four. And from stage four, it starts picking up again. It starts picking up and it starts moving high, and you could wait for a range to form. So from here to here, it can be a range, or from here, you can wait for the high to break out. So once it break, take the highs again, it starts moving again into stage one, right? So it has been, this is stage four, and stage four to stage one, this whole thing then start moving up. So that's how it, that's how the stock works. If you zoom into this chart for a long period of time, you can see the stocks always moves in momentum burst. Stage one to stage two, then stage three of consolidation, then stage four breakout, and at some point of time you can see a huge drop again. So you want to be in a stock which is in stage two, right? If you are a trader, you want to be in phases where the stock is rapidly moving out. So congestion here, this is from a period of 2020, right? So it's breakout here, this high ranges it has been breaking out, and then you look at the acceleration it has. It just doubles in a few months. So you don't need to wait. Your capital is not tied up to one particular stock. It just starts moving higher in a very speed, with great momentum. So that's where you want to be. You want to be in stage two stroke. So you can go ahead with try out with different charts. Try to find stocks which are in stage two, and study this for yourself, right? That's about it. That's a quick video. I will try to come up with more videos, and in a more organized manner. Yeah. Right. Thank you.